Welcome to BigONE Weekly News Update. I'm Mia. Crypto markets continued to trade in a choppy, lower range last week, reflecting a broader environment where liquidity is abundant but increasingly directed elsewhere. Rather than a single shock event, the weakness is being driven by shifting capital preferences, macro uncertainty, and sector rotation. Crypto extends weak consolidation. Digital assets remained under pressure. Bitcoin fell about 3.6% to $63,400. Ethereum slipped around 1% to $1,700, while Solana slightly outperformed with a 1.7% gain. Hyperliquid's HYPE token continued to show relative strength, rising nearly 4.8% to $67. The dispersion across assets highlights a key theme. This is not a uniform risk-off move, but a selective market where capital is rotating rather than exiting. Macro markets stay strong, but capital chooses AI. Equity markets continued grinding higher, led by semiconductors and AI-linked stocks. At the same time, geopolitical developments, including an Israel-Iran ceasefire and renewed expectations around energy supply stability, helped push oil prices down roughly 10%, while the US dollar index moved back above 100. However, the critical driver is not macro liquidity availability, it is liquidity allocation. Capital is increasingly flowing into AI infrastructure, data centers, and compute-heavy industries, rather than returning to digital assets. In other words, liquidity is present, but its destination has changed. ETF outflows signal cooling crypto demand. US-listed spot Bitcoin ETFs recorded approximately $6.35 billion in net outflows over the past 30 trading days, the largest monthly drawdown since launch in early 2024. This marks 6 consecutive weeks of negative flows, pulling cumulative inflows down to roughly $53.4 billion. The data suggests a clear cooling in institutional risk appetite. A key driver is the relative strength of the AI trade, which continues to attract the most active risk capital. Rather than exiting markets, investors are reallocating toward higher momentum narratives with clearer near-term returns. Fed policy signals remain ambiguous. Under Chair Kevin Warsh, the Federal Reserve held rates steady at 3.5%, 3.75%. While the statement was neutral, the dot plot still implied a possible 25 bips per second hike later this year, which markets interpreted as mildly hawkish. Warsh's refusal to provide individual projections reinforces his skepticism toward forward guidance, while new internal working groups on inflation, productivity, and AI signals a shift toward institutional reform. However, from a market perspective, the key point is simpler. Without immediate tightening or balance sheet reduction, liquidity conditions remain broadly supportive. Global central banks edge toward tightening. Beyond the US, monetary policy is gradually tightening again. The European Central Bank raised rates to 2.25%, while the Bank of Japan lifted rates to 1.0%, the highest level since 1995. This does not imply an immediate risk-off regime, but it does reduce valuation flexibility across high volatility assets like crypto. Institutional product innovation continues. Despite weak flows, institutional product development in crypto is accelerating. BlackRock launched a Bitcoin Income ETF, BITA, combining spot exposure with covered call strategies to generate monthly yield. The product appeals to traditional investors seeking income, though it sacrifices upside during strong rallies. At the same time, ultra-low-fee ETFs are expanding. Morgan Stanley's upcoming Ethereum and Solana ETFs are expected to charge just 14 basis points, further standardizing crypto exposure within traditional finance. While this improves accessibility over the long term, it does not guarantee immediate capital inflows without a stronger market catalyst. Regulation expands into tokenization and derivatives. Regulatory developments are accelerating on multiple fronts. The SEC is reviewing reforms that could enable tokenized equities to trade more freely on blockchain-based infrastructure, potentially benefiting platforms such as Securitize, Coinbase, and Galaxy Digital. Meanwhile, the CFTC has moved toward allowing regulated Bitcoin perpetual futures in the US via venues like Kalshi and Coinbase. This represents a major shift for a product historically dominated by offshore exchanges. However, opposition from incumbents like CME highlights that regulatory expansion will remain contested. Key data and events ahead. Markets now turn toward US core PCE inflation data and earnings from Micron Technology. These will help clarify both inflation trajectory and the strength of the AI hardware cycle, two key drivers of current market positioning. Conclusion: crypto markets are not in crisis, they are in transition. Liquidity has not disappeared, but it is being absorbed by AI and infrastructure themes. ETF outflows reflect rotation rather than collapse, while institutional product innovation continues to expand access. The defining feature of this phase is not volatility, but displacement. Capital is moving, just not back into crypto yet. Until a new catalyst emerges, markets are likely to remain in consolidation mode, waiting for the next structural driver. Join BigONE today and take advantage of the growing cryptocurrency market.